What's going on, everybody? This is Jermaine, and welcome to Season 1, Episode 1. And we got our first guest, who is Kimberly Miller. She is a mortgage broker. She's the one who gets you the money, gets you the financing. She primarily works with first time home buyers and also homeowners who are feeling the pressure or feeling the stretch financially. She also takes a special approach, which is an educational approach, and helping her clients understand the best decision for them to make, and also that equates to the long term financial effects that they could have. So, once again, thank you. And did I miss anything?
Thanks for the welcome. I'll just add in that I'm a level two mortgage agent, meaning that I have access to A lenders, B lenders, and also privates, which I use to help all of my clients.
Got you, got you. So, what is the major difference, I guess, between, like, in the sense of getting that financing between the private side and, I guess, the traditional side? What is that about?
Leniency. So the private side focuses on equity. So in the event that you're not able to make your payments, are they able to flip your property quickly? They are less rigid about how long you've been working at a place, your credit history, how long you've been in Canada. As opposed to an A side or B lenders, or I suppose A side in general. But the banks typically look at how long you've been working somewhere. So 2 years is traditionally a minimum. Credit score, usually 680 and
Okay,
up is what we're looking at. So just when it comes to how lenient they are with the applicant's profile.
got you. Okay. And then after, so with 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 your career so far, when you became an agent, what is something that surprised you the most with individuals and purchasing their home?
I would say options. I didn't realize, that there was a private side because not a lot of people spoke about it back then, which is one of the reasons why I became a mortgage agent, just to help people know their options. Another thing that surprised me is that not a lot of people even knew where to start, which is why I have an education-based approach, just to guide people with the knowledge that they need to secure their financing for their home.
Got you. With what is the benefit? Because I hear a lot of people do talk about private side of the mortgage. What is the benefits of even going private? Because I'm assuming that the rates are a little bit higher because it's private.
Yeah. So the rates are higher. Like it's not your first choice, I would say. But the benefit is that if you are in a jam, privates can help you in the sense, like, let's say your credit score plummeted and you are facing foreclosure, a private can swoop in and save the day from your house going through that power of sale, let's say. Or if you know that you're going to be able to have a good exit strategy, but you just need the private for a temporary fix, that's one of the benefits.
Got you. And when you mean exit strategy, how is that helpful? Or how does that occur? Like, what do you mean by the exit strategy?
So let's say someone went through a consumer proposal or bankruptcy, no standard lender would touch them, right? So depending on how recently they came out of that situation. So a private would be an option either to keep their mortgage running or enter the market. And then by exit strategy, during that time while they have the private, they would be building up their credit with like a new credit card, like a Capital One card, regular payments to a cell phone, car payments, stuff like that, building up their credit to get into a space where they can move up to a B lender and ultimately an A lender.
Got you. Okay. So, what is, I guess you could say, the biggest myth that individuals currently have when entering the market right now? Like, what do you see the most misconceptions, mis, I guess, people not understanding or just figure this is how exactly how it goes?
The biggest misconception that I see would be the down payment amount. Many people think that it's 20% that's required for down payment, but that's not the case. You can get in for as low as 5% down of your minimum purchase price, depending if it's $500,000 or less, 5% is your minimum. So a lot of times people think that 20% is required, but that's only if you want it to be uninsured. So the CMHC will have like a insurance that supplements your mortgage. Like that goes into the mortgage amount, which allows you to do that 5% down payment. Another misconception is that people think the amount is so high, which deters them from getting into the market. But the amount that you're looking at is really not that expensive. There are more expensive bills than the additional mortgage insurance that's required. Mortgage default insurance, just to clarify that as well.
Okay. So one thing I've seen or even heard lately is some individuals when they go to purchase a house, or even with the condo market right now, how it's going the completely wrong direction.
Yeah.
Some builders were saying, "Oh, 5% down is only needed," but when they go to the bank, now there's an issue. What happens there? Like, where's the disconnect that happens there?
So personally, I haven't heard the 5% down um situation yet. So I'm not sure where that disconnect could be. It might be a promotion that they may have. It could be builder specific. So
Mm,
that I don't have a take on.
got you. Okay, okay. Yeah, because I always see that, and after, like, I guess some individuals that I work with, they be like, "Oh, I put my 5% down," and all of a sudden the bank's asking for more, and I'm just like, I always just wonder, it's like, what took place there?
So the only situation I know where the bank asks for more is when the person puts down their deposit and it's time to close, but the property isn't valued at what it was when they made that purchase. So they have to come up with a difference.
So,
Yeah, which is pretty common nowadays.
so can you break down that scenario, like in terms of putting down more, like, so let's just say I put down, for mathematical sake, I do the under the 500,000, I put down my 5%, right? But
Mhm.
you're saying the value for the property is not there, so the value went down.
Yeah. So you'd have to make up the difference of what the mortgage amount
God.
would be because you still need the full mortgage. It's just the market
Mm-hmm.
value is no longer there, but you're still asking for the full mortgage because that's what you purchased it for. That's your purchase price. So the bank will only give you what it's valued at. So let's say you bought a $500,000 condo and now it's valued at 400,000. You'd have to put up the
Yeah.
difference minus what you already put your deposit at. So that's where a lot of people are running into problems because what they purchased it at,
Mm-hmm.
it's no longer valued that high. So they have to come up with a difference. Otherwise, they lose their property, they lose their deposit. So it's a common situation happening right now because the condo market is plummeting so hard.
Wow. So just kind of, I guess, brainstorming that, wouldn't have been easier for the builder to kind of say this is what the property is valued at for them to get the
Well,
sale.
well, at the time when they were selling it, like for example, if
Mm-hmm.
someone bought a condo 2 years ago, it was valued a lot higher than it
Yeah.
is today. So the builder can't really say, oh, well, it's valued at 300,000 because no one could predict where we're at right now. That's what it was going
Yeah.
for at the time. So people purchased it for that price. They can't say, okay, here's a discount because that's the cost that they were selling it for. That's the price. So for them to go and like start offering discounts to buyers, then they're going to run into problems as well. So it's on the buyer who has to figure it out or lose their deposit.
That's tough. That's tough.
Yeah, very.
Like, I seen like a couple developments. I think in Toronto alone, there was like 9 developments that they said we're no longer gonna do it because it
Yeah,
doesn't make no sense for the developer to do the project.
yeah,
But thanks for clarifying that one for me.
yeah.
Um, when
Pre-construction.
you're working with go ahead. Sorry.
Oh, sorry. No, I'm saying pre-construction,
Yeah.
it has its pros, but it does have a lot of cons that a lot of people aren't aware of, especially because a single buyer could just walk into a pre-construction office and make their offer, and they miss out by not having a realtor or even a lawyer sometimes go over it, which makes them run into problems because if they sign that paper without reading it thoroughly or having legal
Mm-hmm.
advice, they can put themselves into a situation that they can't get out of.
Got you. Got you. So basically, you're better off, even though you can walk in on your own free will, but you're better off bringing a representative to come with you and look over all the paperwork.
Yeah, so go in with a realtor, or even like once you do get the document, don't sign it right away. Get a real estate
Mm-hmm.
lawyer to look it over for you.
Got you. Okay. So when you're dealing with some first-time home buyers or even an investor, what are some red flags that you see even prior to them trying to finish the deal or close the deal?
With regards to like the
Like,
property
if
or
they're
with regards to
like
the
in
buyer?
terms of now that the finance aspect of it, like, do you look at something and you're able to kind of distinguish this deal might not make any sense for them, and they're like so gun ho and excited to do it?
Yeah, there are situations where, let's say their down payment doesn't make sense, like they're suddenly getting large sums of money. That's a red flag. The lender will
Mm-hmm.
flag that, like where is money coming from. There are situations where, because I do work in investment advice as well, where I run numbers and different
Okay.
scenarios, and sometimes the investor will try to go above what's recommended, which the deal might work provided they have the down payment, but for their bottom line, it doesn't make sense, like for them to have a profit just because they want a particular property. That's like a red flag, which a lender wouldn't flag, but I would flag it depend based on what they're looking for. Um,
Mm-hmm.
yeah, there's pretty much two scenarios there.
Okay. You said something interesting there, but I was listening to your whole thing. So, in terms of when they're getting the first time when they're getting their mortgage. So let's just say a first time home buyer is about to get their mortgage with you. What are some things that you suggest them not to do prior to getting their home?
Don't quit their job. That's number one. Like,
Yes.
don't do that. Don't transfer large sums of money without being able to explain it because anti-money laundering rules are very tight and it's very easy to get flagged if you have like large sums of money of $10,000 coming in or out where it's like, okay, why is this only coming in? Where is it coming from? What is the purpose, you know?
Mm-hmm.
Mm, what else? Don't take out any new credit, so don't go and furnish don't start to buy like furniture for the property before you get in there because new credit lines are also a red flag for lenders. Um,
Got you.
yeah. Those are like the three major ones.
Okay. Um, and what about, so some individuals don't realize, well, what you said, the financial aspect. What about, like, I guess you could say the TDS score? Would you be able to talk about that and elaborate on that? Like, how does that come into factor? Because I heard that word or that term getting tossed around a lot. Oh, your TDS score, your TDS score, but some people don't realize what that is.
So your GDS TDS ratios are based on your debt to income ratios. So standard would be 39% and 44% for GDS TDS respectively. And that's pretty much the the maximum that a lender would go to. If you are above 39/44%, you're going to be out of their guidelines and they're going to majority of the time say no to your deal. And that's when you'd have to go to a B lender who's a little bit more flexible. So it's just allowing how much of your debt to income is allowed to be over their guidelines. It's based on
Got you.
like your monthly expenses, yeah. So they're looking at like, can you afford it? Can you afford it comfortably?
So what gets factored in? So let's, for mathematical sake, let's just say you if you make $100,000 a year,
Mhm.
that means your total debt to service ratio can only be between 39 to 44,000, and then after that's getting broken up into, I guess, obviously into 12 for the year.
Mhm.
um what are some things that factor into that score that the bank takes into account? Like, obviously, I guess your, like, your visa and your line of credit, but is there anything else?
Your car payments, if you have any student loans, if you already own a property, like if you already own a rental property, that factors in too.
Mm-hmm.
So anything that is debt. So, like you said, credit cards, lines of credits, if you have a property already, home equity line of credit, student loans, car loans. So anything
Got
that
you.
like hits your credit, except for maybe like your phone payment doesn't really count unless it's like in collections or something. But
Mm-hmm.
anything that's in collections would count. But aside from that, that's pretty much what's being looked at.
Got you. So basically, for anybody out there that's about to buy a house, don't go buy the new Benz first. Don't do it.
Exactly. Get it
Don't do
after.
it. Get it. Got you. Got you.
Yeah.
Um. So once they close, what are some numbers that they don't factor in when they're about to close the house?
The closing costs. So if they're a first-time home buyer, they do get rebated on the land transfer tax. If you're not a first-time
Mm-hmm.
home buyer, then you do have to pay that. Your legal fees. So your lawyer who's going to be doing the closing, you're going to have to pay that as well. Um, anything random. So like let's say you're buying a condo and there's maintenance fees, there could be an overlap where you may have to reimburse the seller for what they already paid for that partial month. So that's something you have to factor in as well, which people don't really think about. Cost to set up things like utilities, If you have like water bills, your cable, stuff like that, that you have to set up, those setup costs people don't really think about. So it's like a lot of
Okay.
little fees that could add up that kind of like out of
Yeah.
sight, out of mind until you're in it.
Yeah. So for the individual right now that's looking to purchase their first time home, if the purchase is 500,000, how much money should they have set aside to cover all those expenses?
So generally you want to set aside maybe 1.5 to 4% of the purchase price for your closing cost. It's just a general rule of thumb. Everyone's a little bit
Okay.
different, but that's pretty much what you're looking at.
Got you. Okay. And I have another question. Like in terms of the rates, like right now there's so much conflict and I guess undecisiveness in the market. What do you think is going to happen with the rates? Because I think the next rate announcements is April 29th.
So for variable, they're predicting that it's either going to stay the same or maybe even drop a little bit lower, but no one really knows until the day comes. With fixed
Yeah.
rates, it's affected by the market. So because of like the oil issue that's happening in the Middle East, fixed rates are also
Mm-hmm.
going up, just like gas prices, because it's very sensitive to like those market conditions. So I guess it's kind of to be determined. No one can really predict for sure. But when it comes to variable, I do predict it kind of staying the same for the most part, and maybe like a minor, like a 0.25 decrease somewhere down the line. Nothing major there.
Okay.
But that's just my guess. We never know.
I hope your guess is correct. That's what I'm hoping for.
Yeah.
Because things need to be a little bit more cheaper per month.
Yeah.
Um.
I mean,
So.
even with like the fix, like people who had their mortgage 5 years ago who were looking at the 1 to 2% are still
Mhm.
facing that sticker shock, I'll call it, or the rate shock, regardless of how high or low it may seem to us right now, because going from, let's say, 2% to 4%, that's a drastic difference for somebody. And the
Yeah.
last few years have not been kind to the economy and most people. So if you're already in a situation where your credit load is high, you're already like barely making it month to month, that increase, that 4%, 3.5%, whatever the case may be, that
Mhm.
jump right there could break a lot of people.
Gotcha. And with the different type of, I guess you could say, mortgage products they call it, what different like so there's variable and there's fixed. Is there any other type of, I guess you could say, mortgage in the mix, like that you suggest somebody to get or you would stay away from at this current moment?
I am going to dive into the variable rate because variable has um, another factor to it, another type of product that we'll call it. So there's
Okay.
adjustable rate mortgage and then there's a variable rate mortgage. So adjustable rate mortgage, that fluctuates based on the Bank of Canada prime rate. That's when the lenders adjust their rates. So your payment every month will change based on that rate. But with a variable rate, the amount that you pay per month is fixed. It's just within that payment, the amount that goes towards principal and the amount that goes towards interest changes. So a lot of people
Got
are
you. Okay. So one of them, the payment stays the same, but depending on what happens in the market on the rate announcements, let's just say for example you pay $2,000 a month
mhm,
and 1,500 of it was going towards interest and the rest was going towards principal. But if the rate goes up, that 1,500 can turn into 1,700, and after then you're paying $300
principal.
into your
Yeah,
principal.
yeah,
Got you.
yeah. So with a fixed rate, that stays the same regardless. Your rate's your rate, and whatever's going to principal, whatever's going to interest stays the same generally for the term.
Okay, got you. Okay, makes sense.
So what could
And
end up happening with your if you're with a variable rate, if there's a trigger point. So if it gets to a certain rate where the principal isn't being covered properly, they can increase your monthly payment to make sure that you're still hitting like you're still covering interest, you're still covering like what you're supposed to within that payment.
oh wow. So
Yeah.
basically, let's just say if my payment was just the $2,000, but the rate went up to, and I am $25 short. They could increase my payment to $2,025.
Yeah, to cover to make sure interest is covered.
So at that point, you're praying that the rate goes back down because
Yeah.
now, in general, nothing's going towards principal. Everything's
Yeah,
going towards interest.
exactly. So with the adjustable rate, which is actually more
All right. Thank you for explaining the variable rates. That was perfect. So, if you had to, so I got two questions, and one question is particularly to, I guess, the more seasoned investor. So there was a new rule that came out that I think it's along the guidelines of if you're going to purchase your second home, you cannot use your first income that you used to purchase the first one. How does an individual get around that or even get more if they're kind of like putting up so much barriers and trying to hinder an individual success? Like, how does that work?
Um, Honestly, I'd probably say buying with more than one person. So I believe the rule is you cannot use your income from your first property to say that you're going to use it for your second property because, like, how, right?
Mm-hmm.
But I mean, I don't make the rules. I don't always agree with them. So in that case, I would say maybe if you're buying, I feel like maybe like co-buying would be an option because then you're using someone else's income. And honestly, I haven't had to deal with it just yet. So I
Mm-hmm.
don't have a workaround for it just yet. But when the time comes, I'll have a better answer for you.
Got you. Got you. All right. So one more question then. If you had to change the way the process is in terms of buying a home, what would you change to make it more friendly for individuals to get into the market?
If I could change the rules, oh man, there's so many things that like I would say maybe the GDS TDS ratios, just because B lenders are more lenient, privates don't care. A lenders are very strict, they're very rigid about it. And I feel like every person's situation is different. So even though on paper it might look a certain type of way, sometimes people have income from other places. And I know it's our job as mortgage agents to show their income, but sometimes people do things where it's cash and even though it looks a certain way on paper, they're okay financially month to month.
Yeah.
So just like I guess a little bit more leniency when it comes to the GDS TDS ratios for across the board. And I'd also remove the stress test. That's probably the major thing. Because with the stress test, that whole adding 2% to the rate to show
Yeah.
that like they can afford it in case they're stressed out or whatever, I don't think it works. Because if it did, the amount of delinquent mortgages that we have right now, especially like in 2026,
Mm-hmm.
it's ridiculous. And that's due to high credit cards bills, people running into problems, job loss, the economy, et cetera, slow work, whatever the case may be. The stress test doesn't account for those type of situations.
Yeah.
It's saying, oh, if the rate goes up 2%, can you afford it? Okay. That's one factor. There's so many other factors. I feel like that is like the ultimate gateway because it reduces someone's buying power initially by at least $100,000.
Yeah. Oh, that's a
So,
lot. That's a lot.
so it's like that $100,000, it doesn't tell the whole story.
Yeah.
Yeah.
Like even the system itself has some type of has a flaw because if they're looking at what someone can actually afford, right? So what is it? So when the banks are looking at approving you, they look at your gross, and gross is what you get before tax, right? Is that
Mhm.
it? So if that's the case, why don't they just look at your net, what you're actually taking home?
Yeah.
So right off the bat, if they're looking to actually see affordability, why don't they just go see your look at your net alone? But they
Yeah.
don't do that.
No.
Yeah.
Because even people like let's say you have a great income and
Mm-hmm.
your debt to your GDS and TDS ratios are great, they're not looking at like how much you spend on Uber every month,
Mm-hmm.
right? How
Yeah.
often are you like spending at, Yorkdale shopping or whatever? Like how like like what is your savings amount? They're looking
Yeah.
at the ratios. They're looking at like, oh, okay, they make a good income. Who cares if they have $2 in their bank account? They're gonna have 10K next month. But it's like if it's a reoccurring cycle where you don't have any savings, they're not looking at like what your whole financial house looks like. Do you have savings? Do you have investments? Do you like they're not looking at that. Not to say that they should, but like there's more to the story than what they are nitpicking about.
Yeah.
But
Most
I don't make
definitely.
the rules. I'm not a lender.
Oh, but it's as you said, it's just one of those things where sometimes the rules, one rule doesn't apply to everybody, but they try to fit everybody into one box. And I
Yeah.
guess that's just to kind of save them. But in terms of getting everybody a house, that's not the objective for them.
Not for A lenders. Like there are various products. Like you can get a mortgage based off your net worth because they do
Mm-hmm.
have net worth like net worth programs
Oh, they
where
do.
yeah,
Okay.
yeah. So if you have like a certain amount of money, you could technically qualify for that because your income can cover your property and then some. So I mean, you're not stuck with the traditional rules.
Mm-hmm.
So there are various products that can work for you, like if you're business for self, the high network, as I mentioned, newcomer programs, etc. There are various products out there, but there still are certain rules like the stress test, like the ratios that kind of cause a hindrance sometimes when, again, the whole story is not being told.
So you said something else just now. The newcomer program. What's that about?
It's just a little bit more lenient where it's like they understand that someone who's new to the country might not have a full credit history like the rest of us. So there's some
Mm-hmm.
leniency when it comes to that. Um, the requirements are a little bit different when it comes to how long you've worked here for. Um, you know, just I guess kind of to level the playing ground because we've had such an influx of newcomers in the past 5 to 10
Mm-hmm.
years. So to kind of help them become homeowners as well.
Got you.
Mhm. So there are options out there. It's just finding the option that suits you and, hopefully having a large enough down payment to make it work.
Oh man. Yeah, the down payment, and it kind of sucks because right now a lot of people, you probably even came across some individuals that they did exactly what they're supposed to do. They saved up the money for 5 years. They put down their 20%, and all of a sudden things just went in the completely opposite direction. And literally, their down payment or their equity that they had in their house is gone. Like
Yeah,
it's just one. It's sad to see.
yeah. And that's why, like I said, I take the education approach because it's one thing to get into the house, but once you're in the house, what you do matters. So if you're
Yep.
still spending the same way that you're spending before and you're not building up like an emergency fund or in case the fridge breaks fund, like, those
Yeah.
type of like maintenance things. Because when you go from being in an apartment and something happens, you call a landlord and say, hey, my fridge is broken, and they bring you another one, or I don't really think they
Yep.
fix it, they just bring you another one from their stash, right? You don't
Yep.
have that. I'll call it a luxury. You don't have that option when you're a homeowner. It's on you. Either you call the
Yep.
manufacturer, you call the fridge repairman, or you buy a new one. So it's
Yeah.
like that money has to come from somewhere. And if you don't already have that fund available, you're most likely using your credit card, right? Let's say then you
Yeah.
get laid off from your job and you're in between work and you have to pay your bills. Then there goes another credit card, right? And then that cycle continues because then you get the job, but you have to, and then you're playing catch up. You're paying those minimum payments and you're just getting deeper and deeper and never coming out. And then next thing you know, boom, there's no equity in your house because the market sucks and you're up for renewal. And you're like, what am I going
You
to
can't,
do?
and there's nothing you can do because just like you're stuck between a rock and a hard place because you can't sell
Exactly.
because you lose everything, and it might not even sell for what you owe the bank. So
Yep,
you literally gotta figure it out somehow, some way to keep it.
exactly. So it's a tough situation. It's happening a lot right now. A lot.
Yep, and it's not getting any easier, especially depending if, as you said, if the rate goes up on the 29th. Like some
Well,
people
that's
just,
only that's only for variable holders. If you're fixed, your rate is your rate. Like that
yes, that is true.
too. Unless you're like looking at bond yields and you're looking to enter the market. But if you're already in a fixed rate, those changes don't affect you.
So the variable for the person who's on variable, and then after the person who has a mortgage up for renewal.
Yes.
Yeah.
So that's where it's affected. Like if they are up for renewal and they're looking to get into a variable rate, then yes, they're going to keep an eye on the Bank of Canada announcements. If they're looking to get into a fixed rate, then they're going to keep an eye on what's happening with oil and what's happening most importantly with bond yields, because bond yields directly affect fixed rates.
And could you just describe what the bond yield is for the individuals that don't know?
Like, what do you mean? Like what a bond is, or
Yeah, like because some people might not know what the bond is.
uh, it's kind of like similar to a stock.
Okay.
So yeah, similar to a stock, but it's a bond and it's based on like market changes and whatnot. I don't know how to describe them unless I'm not going down the whole economic rabbit hole.
Got you. Okay, 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 okay. That's fair enough. That's fair enough. Alrighty. Well, thank you so much for being on the podcast. I truly appreciate it.
Sure, thanks.
No problem. So, everybody, I'll get you the contact information if you need a mortgage broker. Kimberly Merrill is your person. Till next time, take care.
You too. Thanks.